Here's something that makes no sense. A brand new car can sell for almost nothing above what the dealership paid for it, and the dealership is thrilled to let you drive it away. On some new cars, the front-end profit, the number you fought over for 45 minutes, is a few $100s. Sometimes it's zero. Sometimes the dealer loses money on the car itself. And they still smile, shake your hand, and walk you down the hall. Because the car was never the point. You just won a boxing match that didn't matter, and now you're walking, cheerful and exhausted, straight into the room where they actually get paid. It has a desk, a computer, a box of tissues, and a person whose entire job is the part of the deal you stopped guarding. It's called the finance office. And in the car business, everyone knows the truth. The sale happens out front, but the money is made in the back. Every car deal has two profits, and the dealer thinks about them completely differently. There's the front end. The price of the car minus what the dealer paid for it. That's the number on the sticker, the number you negotiate, the number that makes you feel like a warrior when you knock $1,000 off. And there's the back end. Everything that happens after you say yes. The loan, the warranty, the insurance products, the add-ons. Industry people call this whole department F&I, finance and insurance, and it is, quietly, one of the most profitable rooms in the entire building. On a lot of deals, the dealership makes more money in the 20 minutes you spend signing papers than it made on the entire car. So when you grind the salesman down on price, understand what's really happening. You're not beating the house. You're moving the game to a table where the house has a much bigger edge and where you've already let your guard down because you think the fight is over. It wasn't always like this. Decades ago, dealers made real money selling the metal. But then the internet happened. Now you can pull up the invoice price, the incentives, the price 3 dealers across town are advertising, all before you leave your couch. Price competition got brutal, and margins on new cars got squeezed to the bone. According to industry data, gross margin on a new car is often just a few percent. And after the dealer pays the salesman and the overhead, the profit on the vehicle alone can round to nothing. So the business model quietly flipped. The showroom became a place to get you in the door and get you to commit. The real profit center moved to the back office and to the service department. Selling you the car is the customer acquisition cost. Financing you, insuring you, and protecting your paint is the business. This is the big one, so slow down here. When you finance a car through the dealership, you probably think the dealer is just connecting you to a bank, like a helpful middleman. That's not quite what happens. The dealer sends your application to lenders. A lender looks at your credit and sends back a number called the buy rate. That's the actual interest rate you qualify for. Say a lender approves you at 6%. Here's the part nobody explains. The dealer is allowed to add points on top of that and quote you the higher number. They tell you 7 or 8 or 9%. You qualified for 6. The gap between what you qualified for and what they charge you is called the dealer markup, or the finance reserve, and the dealer keeps a big slice of it as pure profit. You never see the buy rate. You only see the marked up rate, presented as if it fell from the sky. 2 extra points of interest doesn't sound like much when it's floating in the air as a percentage. Let's make it real. On a $35,000 loan over 6 years, moving from 6% to 8% can add well over $2,000 in interest across the life of the loan. That's $2,000, quietly, for the exact same car, the exact same you, the exact same lender, just a different number typed into a box. And the beautiful part, from the dealer's side, is that it hides inside the monthly payment. You don't feel $2,000. You feel maybe $30 a month. $30 a month sounds like a rounding error, so you shrug and sign. That's the entire trick. Take a big scary number, slice it into payments so small they feel harmless, and let time do the rest. For a long time, this markup was almost completely at the dealer's discretion, which created a problem beyond just cost. If the amount added on is a judgment call made deal by deal, different customers with identical credit end up paying different rates. Regulators noticed this could track along lines that are flatly illegal to price on. Back in 2013, the Consumer Financial Protection Bureau and the Department of Justice went after one of the largest auto lenders and reached a settlement worth roughly $100 million over exactly this kind of discretionary markup. The pressure pushed a lot of lenders to cap how much dealers can add. commonly around 2 to 2.5 points, or to move toward flat fees instead. So the wildest abuses got reined in. But the mechanism itself, the marked up rate hidden inside your payment, is still standard practice today, which is why you protect yourself the same way you always could. Here's the move, and it's almost embarrassingly simple. Get your own financing first. Before you ever walk in, go to your bank or a credit union and get pre-approved for an auto loan. Now you have a real number in your pocket that a real lender gave you. When you sit in the finance office and they quote you a rate, you say calmly that you'd like them to beat the offer you already have. And now something wonderful happens. The whole thing flips. The dealer can still shop your application, and sometimes they genuinely can beat your credit union because they have that markup room to give some of it back and still profit. Great. Let them compete. But you've turned their hidden advantage into an open auction. And an open auction is the one thing that market absolutely does not want. Quick pause, because what comes next is the part the finance office really doesn't want floating around online. If you're getting value out of pulling these deals apart, seeing exactly where the money hides and how to keep it, hit subscribe. That's the whole deal here on Priced. We take the everyday prices you never question and we show you the machine behind them. The part that only makes sense once someone points at it. Subscribe and stick around, because we still have the products they sell you after the rate is locked. And one of them has a markup so large it's almost funny. The rate is locked. You relax. Now the screen turns toward you, and the friendly person starts talking about peace of mind. The first offer is usually the extended warranty, technically a vehicle service contract. And look, it's not a scam in the sense that it's fake. It's real coverage. The scam, if there is one, is the price, because this is one of the most heavily marked up things in the entire building. The dealer buys the contract from a third-party provider for one number and sells it to you for a much bigger one. Industry estimates put the markup on these contracts at 100% or more, meaning a contract that costs the dealer $1,200 or $1,500 can land on your paperwork at $3,000. And here's the tell that gives the whole game away. The price is negotiable. If something has a fixed cost, the price can't move. If they can knock $1,000 off the second you flinch, that $1,000 was margin the whole time. Next product. This one is called GAP, which stands for Guaranteed Asset Protection, and unlike the paint stuff coming up, GAP is actually a legitimately useful idea. Here's what it does. A new car loses value the second you drive it off the lot. So early in your loan, you often owe more than the car is worth. If the car gets totaled in that window, your regular insurance only pays what the car is worth, not what you still owe. And you're stuck paying off a loan for a car that no longer exists. GAP covers that difference. Genuinely useful. The problem, again, is where you buy it. In the finance office, GAP might run you $600 or $700, sometimes rolled into the loan so you pay interest on it too. Your own car insurance company will usually sell you the same protection for a tiny fraction of that, often a couple of dollars a month. Same product, wildly different price. The only variable is the room you bought it in. And then comes the last tier, the products that are almost pure margin. Paint protection, fabric protection, rust proofing, nitrogen in the tires, VIN etching on the glass. These get bundled in and presented as a package that protects your investment. Be honest about what most of these are. Paint protection is frequently a sealant that does little a coat of wax wouldn't, sold for hundreds of dollars. Nitrogen in your tires costs the dealer close to nothing and gets marked up into real money. VIN etching, which you could do yourself for a few dollars, shows up as a line item worth far more. None of these are the reason you came in. Every one of them is a few $100s of margin, stacked one on top of the next, each one small enough to wave through. And that stacking is the entire design. Now, how do they get all of this past you without you rebelling? With one weapon, and it's the question that opens almost every finance conversation. What monthly payment are you comfortable with? It sounds considerate. It's the trap. Because the moment you anchor to a monthly payment instead of a total price, you've handed them the controls. Every product they add gets sliced into that same monthly number and buried. $20 a month for the warranty, $12 for the GAP, $15 for the paint. Each one feels trivial next to a car payment, so you nod along, and by the end you've added thousands to the total without a single moment where you saw a scary number. Insiders call this payment packing. Your defense is a mental rule you refuse to break. You negotiate the total price of the car, the interest rate, and the trade-in as three completely separate things, and you never, ever answer the monthly payment question. Make them show you every number as a total. Step back and look at the shape of it. The car out front is the bait, priced razor-thin because the internet forced it to be. The finance office in the back is where the actual business lives, and it's engineered around one insight about you. After the fight over price, you're tired, you're relieved, and you've mentally filed the deal as done. You've spent all your vigilance on the front end and you have nothing left for the back. So they move the profit to exactly the moment your guard is lowest, and then they sliced every charge small enough to slip under your notice. It's not one big con. It's a dozen small, legal, carefully designed nudges, each defensible on its own, that add up to the most profitable room in the building. Once you see the structure, you can't unsee it, and you also can't be worked by it, because every trick depends on you not knowing which room you're standing in. So here's everything, compressed into things you can actually do. Get your own loan approved before you walk in, and make their rate beat it. Refuse to talk in monthly payments, only totals. Assume every product in the back office is negotiable, because it is. And know that Gap is worth buying, just not from them. And the paint package is almost never worth buying at all. You don't need to be an expert or a hard negotiator. You just need to know that the game didn't end when you shook hands on the price. It moved to the back room, where the dealer has been quietly winning this whole time. And you just learned how to stop it. So next time you beat a dealer on price and feel that rush of winning, that was the appetizer. The real profit waits down the hall. And if that back room feels sneaky, wait until you see the menu your delivery app quietly rewrote. Watch it next.